Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending February 12, 2021. So, first, pardon us for the change in format. There was maybe an update in our software, so I can't really change this view. So, I'll be working on that for next week. And Mr. Gignac, our chief economist, cannot be with us this morning, so I'll be going over the economy and the financial markets this week. So let's start with a look at the markets on the week at the close on a Thursday. So as you can see, black everywhere. So a good week for all asset classes. So a little bit of a pause in the sell-off in bonds. So positive return on the week, still negative on the year. Equities still positive. Again this week, so emerging markets first. After that, you have Canada, you have the Nasdaq, and then EFI, and then the S&P 500. So everything outside of the S&P 500 is outperforming again this week. Year to date, 11% in local currency for the emerging markets. So a very strong start to the year, following a very strong end to 2020. So a good strong momentum here for emerging markets. Price of oil higher on the week. Canadian dollar, euro, and gold all higher. So the US dollar was lower on the week. So COVID, an update on the current situation on the left, vaccination. So the rate of vaccination still growing in Israel. We're up to 70%. The UK, the US still going strong, and you need to go all the way down to find Canada. So we're now close to number 40 in the world for the pace of vaccination. So stagnation here. The good news is that we heard in the news outlets today and yesterday that we should be getting 2 million doses in the next month. So that's about 5% of the Canadian population that could be vaccinated from those doses. So we need a very, we direly need a jumpstart to this vaccination campaign. It's the most important economic factor for 2021 and beyond. But at least good news are coming. On the right, you see US, UK, Canada, Japan. New cases are all trending down. So it's a combination of vaccination, of strong measures. In Canada, it's not really vaccination yet, but in the UK and the US, we're starting to see the effects of vaccination. So at least it's moving in the right direction. So good news there. In the US, so Bidenomics, so Mr. Biden is coming in with even more stimulus. So now what we're starting to see is that there might be a risk of overstimulating the economy and causing too much inflation. So it's down the road. It's not for now, but Mr. Biden's plan to bring 1.9 trillion dollars more in stimulus in the U.S. Should be his plan should become law in the next few weeks. So bank on it. Maybe it won't be 1.9. Maybe some pieces will be left out, but it will be significant. On the left, what you have here is the CBO, the Congressional Budget Office in the U.S. was produced an analysis and showing that even without this further stimulus, the US economy will be back to full potential by the end of 2022. So many people are saying, well, why do we need more stimulus then? Because on the right, some analysis like that from Mizuho Securities showing that with this tranche of stimulus, we could be overshooting the potential GDP by 10 to 15%. So that should be quite an overheating of the US economy if it happens. So we'll see. So there are problems maybe we need to address in the future because, you know, Mrs. Yellen, who is now the U.S. Treasury Secretary, the former Fed chair, she's a specialist of the labor market and she's focusing most importantly on this. So that the labor market in the U.S. is stagnating. We're still below the worst of the 2008 Great Recession, and it seems that we've lost some of the impulse that we've had recently. So if you want this recovery to last, if you want it to be inclusive, you need everyone in the labor market to be able to participate. And if you don't have that, then you could have more important problems down the road. So the logic here seems to be that we will be going boldly now and address potential problems later with other measures. So there is a risk of having more inflation probably later this year or in 2022. For now, it's not yet the case, but it's something to be looking at very, very closely. In Canada, the same thing. The labor market is telling us that Every other sector that is not directly impacted by COVID, job market is still doing pretty well. Last week we mentioned that in January we lost 220,000 some jobs in the US, in Canada rather, but it was pretty much all part-time and it was all in sectors that are directly impacted by COVID. So, and those sectors have lower wages. This thing creates lots and lots of inequalities, or at least they exacerbate the inequalities that were already there. So you need to address this situation to make it more inclusive. So don't be surprised also if in Canada we still continue to support the labor market the way we're doing, because you need an inclusive recovery to have a strong and lasting recovery. So that's the message here. So financial markets. So we've been showing you. I think I showed you this chart, or a version of this chart, in the last few weeks. The recovery that we're living now is the light blue line here on top. This is since 1957. If you put all of the rebounds of the lows, this is the fastest, strongest rebound we've seen yet. All of the other times when we saw strong recoveries similar to this one, like in 2009 and 1982, well, we're at the junction that we're now. We started seeing maybe some volatility or a pause, at least in the rebound. So we showed you many charts in the last few weeks, reasons why there might be lots of exuberance and why it might be time to not be at maximum overweight equities, maybe being more neutral, just taking profits on winning positions. So we do still see this. We see signs of exuberance, but I also wanted to show the other side of the medal here today. Yes, it's exuberance in the short term, but the fundamentals remain pretty strong. So what that means is that if we do have some volatility or a pause or a correction, just like in those other bull markets, well, we think it will be a buying opportunity. So we remain positive for the long-term trend. So first, earning revisions, and this is a global equity earnings revision. So the number of stocks that are upgraded versus downgraded by analysts. Well, as you can see, it's as good as it gets. It's a record high. So every earnings expectations around the world for businesses are upgraded. There's lots and lots. If you take the net, it's strongly upgrade the upgrade ratio strongly surpasses the downgrade ratio, and at an historical rate. So we're seeing businesses making more profits 2021, 2022 with vaccination, with fiscal stimulus, with monetary stimulus. Everyone looks at businesses and see earnings that will be growing, so they will be growing their profits. So it's a strong tailwind, a good fundamental to support more gains in equity. So that's first. If we dig into financials, when financials on the left, you have the financials versus the S&P 500. So it's a ratio between the two. So when it goes up, that means that financials are outperforming the S&P 500. As you can see, it's tightly linked to the slope of the yield curve. So the 10-year minus the 2-year rate. There was a disconnect in January or late January from the GameStop volatility, but now if we have a reconnect, we could have a strong outperformance of financials versus the S&P 500. So the financial backdrop, or the interest rate backdrop rather, supports financials. On the right, the forward earnings estimates, the revisions over 3 months. Well, financials first, materials, then tech. Tech remains a strong money printing business. So tech remains a good and interesting sector to be invested in. But financials and materials, so cyclicals, are having a tailwind here from earnings. So you have very strong fundamentals. You have good reasons to be invested. As I said, you never get poor by taking some profits. The best investment that you can make is the one that doesn't cause you to lose sleep. So that means if you are nervous now, scaling back some, but remember that staying in the market is the best long-term strategy, and there are many reasons here to be staying in the markets. Maybe since that it was light this week with topics, I thought maybe I'd bring maybe do some little education here on SPACs. So if you follow market news, maybe you've seen that term left and right. So what are they and what they mean for the markets? On the left, you see the S&P 500 for the last let's say 6 months in blue, and the pink line, which is going into the stratosphere, is the SPAC index line. So SPACs are kind of blank checks companies. So it's a company. If I were to start a SPAC, I would offer an IPO, so an initial public offering of shares of a company, and the plan of this company is to buy some other company, and you don't tell anyone what it is because for compliance issues, you just say, well, my goal is to buy another company. So it's kind of you give a blank check to someone and say, well, I hope you buy something good, and the thing that you'll be buying probably now it's private. You will be taking it public, so it allows me to go into the private market and maybe find some diamonds in the rough. But it's a bet. You don't know what you're gonna get, so it's really a blank check that you send to a company. And these things have been around for a while, as you can see on the right, since 2004. Every year there were some deals on SPACs, but now there's this strong growth since last year. So another sign of fraud, another sign of speculation. But so far, people love their specs, and there's a strong tailwind to this market. So let's see how long it lasts. But if you see this and you wonder what that is, well, it's a very speculative market. It's not a large market, but it's a very speculative market. And as long as it's going this strong, it shows you the risk appetite that is out there. So something to monitor for sure. So what to watch next week? In Canada, we'll have retail sales, manufacturing sales, and a CPI inflation. In the US, a very busy week with the building permits, housing starts, existing home sales. We'll have the market, manufacturing, and services PMI, retail sales, industrial production. So a very busy week next week. So that wraps it up for the week. Again, sorry about the display here. There was an update in the software. I don't know how to change that. So we'll see what we can do next week. But ia.ca/economy is your go-to web page. If you haven't done so, you can subscribe to the newsletter. If you want a copy of a PDF copy of this presentation, economics at ia.ca, economics ICS at the end of economics at ia.ca. You just write and we'll send you a PDF copy of the presentation. So as always, it's a pleasure to have the privilege to serve you. So any questions, ia.ca/economy, you can write an email, and we'll be back again next week with another edition of the weekly economic review.